What's up viewers, Rishabh here, and today we're going to learn everything about all the different kinds of funds that you may come across in your life's financial journey. We're going to learn what they are, how they work, the good and the bad, and how to develop a way to think about them so that the next time someone is trying to sell you a fund, you know exactly what they're talking about. If you like this video guys, please hit that like button and the subscribe button down below to get notified about a follow-up to this video and more such videos in the series. I'll also leave a link in the description down below to a version of the presentation used in this video for your reference. So let's start with the video. What are funds? In the most simplest terms, a fund is a sum of money set aside for a specific purpose. It can be cash stored in a safe, a savings account with your local bank, or a sum of money set aside regularly from your paycheck to be saved for the future, which is also called a systematic investment plan. Here are some examples. An emergency fund is usually $1,000 set aside in cash to cover any financial hardships such as the loss of a job, a sudden illness, etc. If you have kids today and are planning to set aside some money to cover for their tuition in the future, you'll be looking to invest in a college fund, such as the Vanguard's 5 to 9 plan shown here. A trust fund, made popular most recently in the news, is a sum of money or assets set aside by rich people, and it is professionally managed to ensure its distribution to their children after their death. A retirement fund such as a 401k or a Roth IRA is usually offered by our employers, to which both you and the employer contributes by agreeing to deduct some money from your paycheck regularly to pay for your living expenses after you retire. Now, let us look at funds as an option where investors can park their assets. Funds were invented so that individuals could pool their money together to invest in real estate, stocks, bonds, or other financial securities. This way, the combined capital would be spread across different assets. So if one of the assets in the fund is gaining or failing spectacularly, the fund is still able to provide average returns due to the other assets it owns. Often, funds also provide detailed statistical reports which can help analyze the individual assets and track their performance as a whole. Everyday investors like you and me don't necessarily have the time or the skill to do so. Usually, the funds have following goals. First, to distribute the economic gains back to the investors through regular dividends. The second is to prohibit any transactions that the fund managers may make without having a sound theory or a rationale, which means they try to protect the investors from speculation. Lastly, they also strive to help preserve the principal or the initial amount collected from their investors. We may want to achieve different things with our money at different points of time in our lives. For instance, if you're young and not living to live off of dividends, you may want your money to grow faster. If you're close to retirement, you may want to start receiving income from dividends, which can help pay for your living expenses when you're not working. Or you may just want your money to maintain its current value for a certain period of time. Funds have become so popular since their inception that you can be certain to find one tailored to your financial needs. Let us now try to focus on the benefits that funds offer. Most funds, which are registered with the SEC, comply with the Investment Company Act of 1940, which protects the fund shareholders by preventing unauthorized access such as hacking or theft to fund assets. The amount owed by a fund to its shareholders can be calculated by a simple formula which is called the net asset value. The net asset value is simply the total assets that a fund owns minus the total liabilities divided by the total number of outstanding shares. The net asset value of funds are usually calculated every single day. This allows the investors to withdraw the money they invested in the fund at a fair price, which is not far from the net asset value. This way, your money is more liquid with the funds than say with other investments such as a house or an artwork, which could take months, if not years, to pay you back the total value in cash. Also, funds often declare their dividends, which can be either quarterly or monthly. They also do not usually split their shares like individual companies. And since you own shares of only one fund, you don't need to file taxes on all the assets owned by the fund. For instance, you can own shares of 50 different companies or choose a fund which owns these 50 companies. Filing taxes is a lot easier when you put your money in a fund. Sounds fantastic! Should I jump in on a fund right now? Well, certainly, you also want to consider its disadvantages. Diversification is a double-edged sword. On the one hand, it offers you the benefit of spreading the risk. But let's say one of the companies, for instance company X, in the fund performed spectacularly this year. It outperformed all other companies in the fund by 50%. The fund itself won't be able to provide you the 50% return this year because it has its money invested across other companies, which may have performed average or far worse than this company. You could also have made more money if you had all your money invested in this company X than if you had it invested in a fund.
Any ideas?
This logically ties into the next point, which says that you cannot take advantage of certain special situations in the market which may raise or lower the prices of company X spectacularly. Some common examples of special situations are mergers, acquisitions, bankruptcy, etc. This aspect is rarely discussed by fund salesmen. Now, let us discuss all the different kinds of funds. Funds may be categorized based on the kind of assets they own. Stock funds may own stocks of companies within the US, outside the US, or companies belonging to a specific sector like information technology, semiconductors, restaurants, energy, real estate, etc. Bond funds may own government, corporate, or municipal bonds, or a combination of them. Currency funds or money market funds own short-term US Treasury securities, federal agency notes, Eurodollar deposits used by non-US residents to conduct business free of US banking regulations, certificates of deposit, corporate commercial paper, etc. Commodity funds own raw materials such as gold and silver or primary agricultural products such as wheat. A more comprehensive list is available in the notes in my presentation. Another way to classify funds is by looking at the way they are managed. Actively managed funds or active funds are funds where the fund managers actively decide where to invest the money on a daily basis. Their goal is to beat the market returns with the investments that are handpicked by their managers. The rest are passively managed funds or passive funds. They're also popular as index funds. For such funds, their investment decisions are made by a formula or an algorithm. For instance, a fund can be set up to follow a stock market index. The belief is that since the index has shown significant growth over large periods of time, a fund whose assets are distributed exactly to match the index should have the same performance as the index. Then we can classify them based on where you can buy or sell shares of the fund. Sometimes you can buy the shares of a fund from the exchange, just like you buy stocks of companies. For instance, the shares of Vanguard's S&P 500 fund can be bought and sold on the New York Stock Exchange through a broker like Robinhood. These are called exchange-traded funds. The shares of mutual funds are only available through the financial institution which owns the fund. For instance, the shares of an exactly similar fund, the Vanguard 500 Index Admiral shares, commonly known as VFIAX, can be only brought through Vanguard. Both of these funds have exactly the same holdings, just a different packaging. If you have made it this far to the video, now is the part you clicked on the video for. The hierarchical classification of all the funds we discussed. As you can see, the funds have different layers. At the very top, we can classify the funds on where you can buy them. Mutual funds, through the financial institutions, and ETFs on the exchange. Note that these are mutually exclusive, meaning that you'll never be able to buy the shares of a mutual fund on a stock exchange. There is a third category here called closed-end funds, but we are not going to discuss it in detail as I strongly urge new investors to stay away from them. Also, they're not that popular, so it can take a bit of time to find them. The next layer is how the fund's holdings are managed, actively by fund managers or passively by a formula or an algorithm. These are mutually exclusive too, meaning that no fund can be both actively and passively managed at the same time. The last layer would be what fund holdings are. Please note that a lot of funds can possess holdings of a combination of stocks, bonds, commodities, or currency. So today we understood what funds are, why they exist, their advantages and disadvantages, and how you can classify them. In summary, the next time you have a discussion with your financial advisor about funds, ask them questions. How are they managed? Can you buy them as an ETF? What are their holdings? Try this exercise to find more funds. Google anything from the second layer, anything from the first layer, and any combination of things from the third layer. If you're new to investing, do not try to buy shares of funds if you do not understand exactly how they work. Try to stay away from closed-ended funds, inverse funds, leverage or inverse leverage funds, etc. Stay tuned for the next video in the series which uses this knowledge you have learned today. I hope you've learned something new from today's video, guys. By the way, I'm Rishabh. I'm an international student here in the US who can't really monetize any of my videos for legal reasons. I love reading about finance and sharing knowledge, so please share this video and engage in the comment section down below. It really helps me keep going.